Have you ever wondered what actually happens when the Fed cuts interest rates? It's not as if Fed Chair Jerome Powell picks up the phone and calls every bank in America and says, you will lower interest rates by 1/4 percentage point or else. The Fed has to make sure that interest rates across the market fall toward its desired target range. And it's a behind-the-scenes process that's a lot more complex than headlines make it sound. Let me explain. Similar to how it works for everyday consumers, banks keep money in accounts at the Fed. They're known as reserves. Also similar to you and me, banks earn interest on those reserves. And when the Fed cuts interest rates, it adjusts how much it pays them. This becomes a floor for how low interest rates can go. It's a risk-free rate. In other words, why would I, as a bank, loan money to someone else for less when I'm not guaranteed to be paid back? But when banks start to earn less in money on their deposits, they'll also start paying you less. It also means, though, that they don't charge you as much to take out a loan. This is a relatively new way of implementing monetary policy, born out of the 2008 financial crisis. Back then, the Fed cut interest rates to near zero, but the economy needed more help. They ended up massively growing the supply of reserves in the banking system. And because of this, the supply curve shifted rapidly to the right, basically making its original tools less effective. Banks didn't need to lend to each other overnight so much anymore. And the Fed didn't need to buy and sell treasury securities to shrink or grow the money supply as much. Thus, a new bombshell, the interest on reserve balances rate, entered the Fed's villa. Other factors are at play that influence how much you pay to borrow money and how much you earn when you save. Those include your credit score, demand for depositors, expectations about where interest rates are heading, and then competition among lenders. And because we're talking about the world's largest economy, research shows that it can take months, if not a full year, for a single rate cut to make its way through the entire financial system.